Thank you all for joining us for today's webinar, From Pasture to Policy, Insurance That Works for You. I'm Michael Delbar. I'm the CEO of the California Rangeland Trust, and on behalf of our entire team here, I want to welcome you and thank you for taking time to be here. As part of our ongoing commitment in serving California's ranching and landowner community, the Rangeland Trust has been expanding our efforts through the development of our programs department. We heard from our landowner partners that they've taken a step to conserve their lands, but they want to do more and learn more. So this is our effort to do that and provide that service to you all. So this department is focused on connecting landowners with trusted professionals and resources to support their operations, whether that's finding funding for conservation projects, learning about new stewardship tools, or navigating complex topics like today in insurance. So we're gearing up for next year with more workshops and webinars designed to help landowners like you stay informed, build stronger partnerships, and access the tools they need to succeed on working lands. As you all know, owning and operating a ranch isn't like any other type of business. It's a way of life that's deeply bound to the land, the animals we care for, and the communities we provide for. But it also comes with a unique set of risks that can change overnight. Across the state, many landowners are facing steep premium increases, shifting policy terms, and shrinking coverage options. With renewal season approaching, it's important to make sure that your policies actually meet your needs, covering not just your property, but your people, your vehicles, and of course, your livelihood. So today's conversation is all about that. Our aim is to help you understand what coverage matters most, what changes are foreseen across the industry, and how to make informed, confident decisions that truly protect your operation. So again, thank you for taking the time and joining us today and for your continued dedication to stewarding California's working lands. And so with that, I'm happy to turn it back over to our programs manager, Robin Hanson, to introduce today's speaker.
Thank you, Michael. Yes, welcome everyone. You might recognize our presenter today, Braden Clark from InterWest Insurance. He joined us in June on the fire mitigation webinar. And on that one, he mainly focused on fire insurance, but he did such a great job that we asked him if he would come back and delve into everything insurance related. If questions come up as you guys are watching this, you're welcome to put them in the chat or write them down. We'll have a kind of open discussion at the end. If you don't want to be the one to ask it, again, just put it in the chat and that's totally fine. With that, I will let Braden jump in and tell you all a little about himself and get started.
Thank you, Rob and Michael, for having me back. As they said, I'm Braden Clark, work with InterWest Insurance. I lead our ag practice group here. I live up in Glenn County with a strong focus on all kinds of different ag exposures, but main focus in ranching, meat sales. So I'm living through this stuff with you guys, seeing it every day, all these renewals coming out, and understand how big of a line item that insurance is becoming. And there's lots of changes that are happening in the market. So I wanted to go over some of that stuff with you all today. So when you get into your renewals coming in, you kind of understand a little bit what to look for and be a little bit better prepared. So I will share my screen. Okay, so I wanted to start off with just kind of doing a little overview of what the insurance market's looking like. So overall, we're seeing some softening in the market. We're seeing some rates come down in some lines, but even though we're seeing that across the board, we're not necessarily seeing that in rural California, where a lot of my clients reside and work, which is unfortunate. So there's a couple reasons that it's not happening. One, it's just difficult space with the wildfire. And a big thing is the Department of Insurance and the carriers are not necessarily on the same page when it comes to how do we fix this problem that we see. So the Department of Insurance, their kind of solution is we just need all these carriers to write more business, and then they'll make them become profitable. And the carrier solution is we need to raise rates. They're not allowed to raise the rates to the extent that they want to. But there is some good news we are seeing a little bit of more competitive market in California. Notably, we have Nationwide Farm, which for the past, I guess it'd be 4 years, 4 years, they have not been accepting any new business. They have been staying on the business that they have, but not accepting any new policies. And now we're starting to see them accept some applications. It's slight good news, but slight doesn't really affect us much because the policies they're looking at are cream of the crop in the middle of the Central Valley, fully irrigated, no losses. So the perfect accounts is what they're kind of considering, which is almost unrealistic, but it's a move in the right direction where we can at least send applications their way because they have historically been the largest insurer of agriculture in the state. So for many ranchers, though, and landowners, the California Fair Plan has still been one of their only options. And luckily, the Fair Plan has been getting a little easier and easier to work with. They've been fixing some of the bugs that they've been having. The time from when you send in an application to get a policy in force has shrunk tremendously. I know when we first started sending full ranches and farms to the Fair Plan, it would take 3 months or so to get something back. And if you've already been non-renewed by your current insurance, that could be time that you don't have any insurance in place at all. So it has been getting better. Communication has been getting better, and their coverages have been getting better. They've increased limits on certain structures that you're allowed to have. They've added in some additional coverages besides just fire. So it's become more of I guess I'd say a real solution instead of just a Band-Aid. So workers' comp has been kind of insurance market saving grace for the last little while. The rates have historically been going down probably the last 5 years. We just got the WCIRB, which is the rating bureau that runs the work comp in the state. They've sent out what they want to see the rates at, and it's been about a 10 to 15% increase that they are saying needs to happen to keep work comp profitable and still affordable. So we are going to probably see a little bit of an increase in rates on workers' comp, but nothing too substantial. And talking about workers' comp, a question that has come up is how we can reduce your premiums in work comp and ways to structure a family ranch when you have family members that are working for you. Do you have to include them in work comp? Can you exclude them and save those premium dollars that way if that's something that you want to do? So there's a couple ways you can do that. If the ranch is in a corporation, the owners of that ranch, if they own at least 10% of the corporation, they can be excluded from the policies. Sometimes you have kids or whoever working on the ranch, and they might not own 10% of the ranch to be able to be eligible for exclusion. There's a workaround where if somebody owns just 1% of the company stock, and they have a family member that's either a parent, grandparent, sibling, or a child, and they own 10%, even if you just own the 1% and you're the family member, you can still be excluded from that work comp. So it's a way to save some dollars on workers' comp and exclude a family member from the coverage as long as they have health insurance. They have to be covered by some health insurance policy to be eligible to be excluded. And for LLCs, a lot of ranches are in LLCs. You can exclude any working member of the LLC. They just have to sign the waiver of exclusion and send that into the carrier. So that's the other way to do it. So when you have, we'll kind of shift gears here. When you're getting your renewals coming in, you're going to notice some differences, and they're not always clear. So there's admitted markets and surplus line markets. So we're seeing a lot of changes with our surplus lines markets. So surplus lines markets are what's called non-admitted carriers. So they're not filed with the state of California. They don't have to provide notices of changes or in a timely manner. So standard carriers, admitted carriers, they have to give you 60-day notices of non-renewals, of increase in premiums, large policy changes. But a lot of these ranches and landowners are already worth surplus lines markets, and they're not getting any notice that these changes are coming. So it's become very, very important to look at your renewals closely so you can catch these changes and know what you're buying. And the underwriters, like I said before, they're not making this stuff clear. So having an experienced broker that you're sitting down with, looking at these changes, understanding them, will go a long way. And we're seeing changes on a lot of different, pretty much all lines of business: property, auto, GL, umbrella. The biggest and the most important changes are going to be on that GL and umbrella, and we'll go over each of these lines as well. So we'll start off with property. So the biggest change that we're seeing is increase in deductibles, where, say, a standard farm policy 2-3 years ago, you had a $500 or $1,000 deductible on your property. It's becoming standard for some carriers to have minimum $5,000. You can't get any lower than that anymore. You can't buy it down. You're going to see a $5,000 deductible. Some carriers are going up to $10,000, $15,000. I've seen $25,000. So it's a big change in coverage where if you 5 years ago you're used to having a $500 deductible, turning in any claim, there's going to be a lot more self-insurance and money coming out of your pocket when claims happen. Another big one, which might get overlooked a lot of times, is the change in valuation. So if you have a house or a pole barn or a structure of some kind that's been on replacement cost, you may see on your declaration page that instead of there being a little RC by the value, it changed to an ACV, actual cash value. And you see this a lot when you go from admitted markets to surplus lines markets, but we're even seeing it in our admitted markets where they won't give quotes or won't provide coverage on that replacement cost basis, especially if the building is a little bit older. So what the difference is, the replacement cost is going to cover the building and pay for what it costs to replace it with something of like kind and quality. Pretty simple, just going to replace the building. For actual cash value, they'll take that building, they will determine what its worth is and apply depreciation. So if the roof hasn't been replaced in 10 years and it's a 15-year roof, you'll see a big discount on the money that you get on that roof. The plumbing, the electrical, just the siding of the building. So when the adjuster is adjusting this claim, you'll see lower settlements or lower offers being given to you when things are on the actual cash value. So just because you still have it insured for $400,000, if that valuation changed from replacement cost to actual cash value, that doesn't mean you're going to get $400,000 because they're going to apply that depreciation to it. And then another thing that we're seeing is your coverage form being changed. You have basic, broad, and special forms. So special forms, what we've always strived to have everything covered on. It's the broadest form of coverage. It covers anything unless it's specifically excluded. So a lot of things that have been in special form historically, we're now seeing being moved to that broad form. And if they're an older building, even to this basic form. So the basic and broad forms, they're covering named risks. So the difference between the basic and broad and then the special, basic and broad, they'll cover any damage or claim that's listed. It comes from a cause of loss that's listed. Special form will cover anything unless specifically excluded. So on the basic form, you have your fire, theft, burglary, vandalism, hail. There's that whole list there. So when you move up to the broad, it'll cover everything that's on the basic, but then it'll include falling objects, weight of ice, snow, ice, or sleet, water damage, which is a big one, and then collapse. So when you get your renewals, things to look at in your property, see if anything changed from replacement cost to actual cash value, and then see what kind of coverage form is listed on there. Do you have basic, broad, and special, and do you understand the differences and know what you're being covered against? So let's move on to some liability changes. So we've been seeing mostly when you have a liability policy, whether it's a general liability policy, farm liability, there's no deductible attached to that. But we're seeing a increase or addition in having a deductible on your liability, whether that be a $5,000 or a $10,000 deductible for any liability claims. So that's something that may have not been there around in the past. The most common exclusion we're seeing that is a very large exclusion is the wildfire or fire damage exclusion. And we haven't been seeing this on our admitted markets, but many of our clients and insureds are in those surplus lines markets already, and these are becoming very, very common. Even if something's called a wildfire exclusion, and that's what the name of the form is, it can be misleading because when you actually read the form, it's not a wildfire exclusion, it's a fire exclusion. And not only a fire exclusion and smoke, anything that's happened from a fire. So if you are even burning a field and the smoke's drifting across the road and that smoke is then said is somewhat caused a accident, or it's somewhat of your negligence that it caused that accident. If you have this wildfire or fire exclusion on there, that can be excluded from your liability policy. If you are burning a field and it goes over the neighbor's property, burns up one of their buildings, their fences, their grass, that would be excluded. So it's not just wildfires, it's almost any fire that you have that gets out of its contained region, whether it be the smoke or the actual fire causing the damage. But we've also seen them sublimiting this coverage. So you'll have $1 million limit for your liability policy, but we've seen them sublimit this to usually $100,000 with a $100,000 deductible is the most common one we've been seeing. So even though you have $1 million limit for fire damage or smoke damage, they'll sublimit that amount to $100,000 with a large deductible. And normally if they're sublimiting it, they have the exclusion already in place and you have to buy back this sublimit. And it's not always very cheap to buy this coverage back if they'll even offer it. But some coverage is better than no coverage. Another large exposure that is now being more and more excluded is any public exposures. So agritainment, meaning if you have pumpkin patch on the property, any kind of U-pick operations, field trips, weddings, dude ranches. So anytime that somebody not affiliated with the ranches, you're allowing them on the property and doing some kind of activity, we've been seeing a lot of exclusions being put onto general liability and farm liability policies that are excluding all of those operations. So if you have someone like that taking place, either make sure that exclusion doesn't apply, or you can get some sort of event insurance that will supplement your current policy to make sure you're fully covered. And even so, you can check all your renewals and your own policies for this, but say you're leasing your land out to another rancher, and you need to have some sort of contract or standards in place for what their insurance should be including. So just because you might not have this wildfire or fire damage exclusion, if you're leasing your land out and the rancher that you're leasing your land out does have that exclusion, his policy won't be covering it, and it's going to come right back to yours. So even if you're getting those certificates as you should be, you're getting named as an additional insured as you should be, you want to make sure that what you're being named on and what you're getting a certificate for is still a good policy and getting you all the coverages you want. So it's always a good idea to set up a checklist of what you should be looking for in a certificate. Make sure there's adequate limits, no big exclusions, no big deductibles that you're going to be worried about, before you're leasing out this land, so you can make sure that you're properly covered, and you don't get your own insurance policy dinged for something that you didn't even do. So auto, let's move on to auto. So kind of along the lines of all the other lines of business, seeing the increase in deductibles, it was always very common for your comprehensive and collision coverage deductibles to be $150, $250. It's getting up to almost a standard $1,000 to $1,500. So if you currently have a policy and your deductibles are under $500, be ready, or at least kind of expect that those are going to jump up to at least $500, possibly $1,000, if not more. But the biggest change that you should be looking out for is changes in your coverage symbol. So when you look at your policy, your declaration page, right at the top somewhere, it's going to say what your symbol is, what coverage symbol you have. And you want to have symbol 1 coverage. What symbol 1 stands for is any auto. Whether you rent it, borrow it, it's an employee's auto, you own it, your liability will cover you no matter what vehicle you're driving. That's when you have symbol 1 coverage. We're seeing a lot of carriers, especially if you have to go to monoline auto coverage, meaning your auto is not a part of your full package. You have your property and general liability somewhere else, and then your auto coverage is with a different company. If you're doing that, we're seeing a lot of carriers only offering symbol 7 coverage. And what symbol 7 coverage means, it's only covers specified autos. So if it's not on your vehicle list, it's not going to be covered for liability. So if you rent a vehicle, borrow a vehicle, your employee's using their own vehicle, there's no coverage under your policy for vehicles like that. So you really want to make sure that you either have symbol 1 coverage, or if all you can get is symbol 7, make sure that vehicle schedule is up to date at all times, or else you could be driving around without insurance. Auto premiums, we're seeing increases with them, 10-15%, and it's kind of been the standard for, I don't know, at least last 10 years or so, that every year you can expect some kind of increase in your auto premium. And then another change coverage-wise, so there's a endorsement that for me and my clients, it's always a standard coverage that we include, and it's CA 9948. What it is, it's a pollution endorsement. So if you were in a vehicle accident, overturned, something fell out of your vehicle, whatever it is, and it causes a pollution event, this endorsement would cover the monitor, cleanup, removing, destroying, neutralizing, whatever you have to do, whatever you're liable for this pollutant, this will cover that. And pollutants, I mean, you have your normal pollutants like your diesel, oil, gas, chemicals, fertilizers, all those kinds of things. But a pollution event could be anything, especially if it's going into a native area, a stream, something like that. Common, or not a common one, but a large pollution claim that we had was a truck tipped over, and he was it was a milk truck, and the milk got into the stream, and it was decided that that was a pollution event because that milk did not belong in that stream. So the normal liability of the policy did not cover it, and we had to use this pollution endorsement to cover everything that this insured was liable for. So when you're thinking about pollution, pretty much just think anything that doesn't belong in where it ends up, whether it be, in that example, milk, or it could be if you have a load of feed and the feed goes in there into a stream on the side of the road or a ditch or something, they can consider that to be pollution. And so this is a coverage that carriers have either been removing from policies, or when you are sending it to them and ask for it to be added, they're saying, no, we're not going to add that, or getting very expensive to add it. but it's a very important coverage that you want to make sure that you have if possible. Okay, so umbrella. So this kind of goes along the same lines of your liability. So normally umbrella coverages have always been a follow form type policy. And a follow form is whatever is on your underlying policy, either your underlying auto, your underlying general liability, or farm liability. The umbrella will just increase the limits of that policy. That's not necessarily the case anymore. The umbrellas are adding in their own exclusions. So even if you don't have a wildfire or fire exclusion on your general liability or your farm liability policy, that doesn't mean your umbrella is going to extend that coverage. They might have their own fire exclusion, so you're stuck with whatever's on your underlying. Your umbrella is not going to cover that. That's, again, the most common exclusion we're seeing right now is that wildfire and fire damages exclusion. You'll also see a total pollution exclusion. So going back to, we were just talking about that CA 9948 for your auto, that pollution coverage on your auto. That doesn't just because you have that for your auto policy doesn't mean your umbrella is going to kick in too if that claim turns into something larger. So those are kind of the two exclusions that you want to be looking out for. We've also been seeing exclusions for that agri-tainment public exposure being added onto umbrellas as well. And then another big thing with the umbrellas, which a lot of people have been experiencing, is just a reduction in limits. You used to be able to go to Nationwide or Zenith or whoever your standard carrier was, and they'd give you up to $10 million of coverage, and it was pretty cheap. All these carriers now, they aren't offering anything more than $2 million. So if you need to have a higher limit than $2 million, you have to go out and get other umbrellas that go over the top of your current umbrella. So we call those towers of coverage. So you might have $2 million with Zenith, another $5 million with another carrier going over the top of that, and then another $3 million over the top of that $5 million, depending on how much insurance that you need to have. And we'll kind of, in a little bit, we'll go into how do you come up with what kind of limits you need to have, because that's always a big question. It used to be whatever you can afford, it was cheap, give me $15 million of coverage, because it used to cost $15,000 to get $15 million of coverage. Well, now it costs $150,000 for that same coverage, so that's not realistic to get that. So a lot of people are reducing their limits, and they're like, well, how do I decide what limit to get? And we'll kind of go into that. So the first thing that I like to look at when choosing the right limit is what kind of contracts you have in place. Do you have suppliers, customers that in your contract with them, they say you need to have a $3 million limit for your liability that includes products, premise coverage, all of that? Or do you have a customer that needs $10 million? So looking at your contract, seeing what coverages they require, and then seeing what limits they require is kind of the first step. The next step is looking at your exposure. And the biggest exposure is going to be your auto exposure. That's where you're going to see the largest claims happening, and most commonly, the most common claims happening. So do you have 3 trucks on the road that don't really go farther than 20 miles from the home ranch? Or do you have 25, 50 trucks and trailers on the road that are going from Susanville down to the Bay Area? Pretty common. The more you're driving, the more trucks you have on the road, the farther they're going, the areas they're going into. Those are all things to look at when coming up with your limits. The more auto exposure you have, probably the little bit more limits you want to have, because your odds of having a claim go up exponentially the more you're driving and the more you're over the road, or especially the areas you're driving in. And then you want to look at what kind of assets you have, what kind of net worth you have. If you have $20 million worth of buildings or property and equipment, you want to have liability coverage to cover all that. Probably not all of it, but you want to have at least a substantial amount, maybe $5 million of coverage, to be a nice buffer of insurance coverage. So those are kind of the three things when you're coming up with the limits that you want to look at. Number one, contracts, what are you required to have? Two, auto exposure, and three, what kind of assets that you have in place. So when you start, it's like Michael said before, it's renewal time. We're seeing a lot of renewals coming in or starting the process. What do you want to be, how do you prepare for that? What should you be doing? So you want to spend some time reviewing your equipment lists, your location list, auto list, drivers, property values. A lot of times, it's a busy time of year for everybody. They'll just say, yeah, just renew it as is, or renew it with per expiring information. So whatever our list looked like last year, let's do it again. But with one auto coverage going from that symbol 1 to symbol 7, you want to make sure you're up to date on that auto list. We're starting to see some blanketing locations going away, meaning we would always add in a line item on your location schedule. That's kind of a catch-all. We'll have all your locations listed, but in case we miss one, we'll have a location that says, and also all other acreages or locations that the insured is farming on or ranching on or has an interest in. So being able to add that kind of protective coverage is going away. So keeping your location schedule up to date is very important too. Did you forget to send your broker that you leased this new piece of land or that you bought this new piece of land? You want to make sure that we're getting those added onto your policy. So spend some time making sure those are right. Your driver list is important. And if you have a pretty large driver list with lots of employees, having your driver bring in a MVR to you before you allow them to drive is important. Because if they end up having a bad driving history and have DUIs or multiple citations, multiple accidents, they could be excluded from your auto policy. So it's always kind of a best practice when you're hiring somebody new, have them bring you their MVR so you can review it and make sure they're acceptable to be driving and they're not putting your auto coverage at risk. So and next we have the property values and mobile equipment list. Kind of go hand in hand. So when we talked earlier about the coverages changing from replacement cost to actual cash value, to me that means that you need to make sure that your values reflect that. Because you don't want to, if you have a building that's replacement cost is $500,000, but it's not covered on replacement cost, it's covered on actual cash value, and actual cash value is probably going to be closer to $300,000. There's no reason to pay that extra insurance covering it for $500,000. So when you see your valuation change on your policy, make sure your values are reflecting that, so you're not overpaying for your insurance. Same thing goes for your equipment list. Can't tell you how many times I'm looking at somebody's equipment list and they bought a tractor or something in 2005 for $60,000, and on their equipment list and their blanket of coverage, it's still listed for $60,000. If that tractor burns up, you're not getting $60,000 for that tractor. They're going to pay you whatever it's worth at that time. But for however many years you've been paying to insure it for an imaginary amount of money that you'll never see, and overpaying for your insurance. So keeping that mobile equipment list up to date, changing those values, accounting for depreciation is important, mainly so you're not overpaying for insurance. And then kind of going back to all these changes happening on policies and then exclusions being added, when you're looking through your renewal, make sure you're asking your broker questions and have them explain what these exclusions are to you. Like, for example, if I have a insured up in the hills and there's that fire exclusion, I'm not going to recommend them buy a policy with that, especially if the policy is $15,000, $20,000. One of their biggest risks is starting a fire and having it get off their property and causing damage. Why pay $20,000 for a policy that's not going to cover your largest risk? So even if there's another option that may be a little bit more, say $23,000, $24,000, but doesn't have that exclusion, you want to buy that one, or else you're just buying a piece of paper that's not going to cover you. And then make sure you have conversations with your broker about your operations and what you guys do, because every operation is going to be a little bit different. Everybody does something that somebody else might not be doing. And if you do have, say, some events on your property or some field trips on your property, or you host 3 or 4 weddings a year, if you don't let your broker know that and your broker's not asking about your whole operations, they may give you a policy that is excluding all of that kind of stuff. They just don't know. So having conversations with your broker, writing out a narrative of what you guys do, how you do it, so when you're reviewing your policies coming in, a surprise exclusion isn't going to be there, and your broker can nip that in the bud and say, yeah, this policy won't work at all because I know my insured is having 5 weddings a year and this public exposure exclusion wouldn't work. And then also be reviewing those certificates. We kind of talked about that earlier when you're receiving all your updated certificates from people that owe them to you. Their policies are changing just like yours are, and so making sure that they still have adequate coverage that meets your standards for what you want these people to have is important, because they'll be having the same kind of changes you are. And then the big one is start early. So you have a renewal on January 1st. December 15th is not the right time to start going through your location list, your auto list, your driver's list, because the carriers are becoming more and more overwhelmed. A lot of people are shopping their insurance around. They're sending it to every carrier under the sun to see what's available to them. So they're going through a lot of stuff. So the turnaround time for these carriers is getting longer and longer. So the earlier you can start updating stuff, getting info to the carriers, the better. So you're not scrambling 3 or 4 days before your renewal, having that extra stress and just binding whatever policy or renewal comes your way without fully looking at it and making sure you're buying something that is actually covering you and giving you coverage that will respond in the event of a claim. So a couple other coverages that aren't necessarily, they're not part of a regular package, but should be part of a full risk management program. First one is the Pasture, Rangeland, and Forage. It's PRF. It's a crop insurance program, and it's a rainfall coverage. So for those not familiar with this, I'll kind of give you the high-level view of it. You take your fields, and you have 2-month intervals that you can pick throughout the year. You can pick multiple of these 2-month intervals. And if the rainfall does not meet the 50-year average for that area, they'll cut you a claim or cut you a check for a claim. And what that's supposed to be covering is the additional cost for feed, essentially. You're going to have to go out and buy more hay because your grass isn't growing like it should be. And that has been a huge saver for a lot of ranchers that we work with that have been buying this coverage through the crop insurance. And then the other one, it's a little bit different, but I thought I'd include it in here. It's the Livestock Risk Protection, LRP. It's also a crop insurance program, and it's based on Chicago exchange prices for different kinds of livestock. And so when you see a price that you like, you can lock in that price. So say you're not going to be selling your calves or steers for another 6 months, but you like the price that there is now, and you know that price will guarantee you cover all your bills, give you a profit. You can lock that in, pay a small premium, and then say in that 6-8 months, whenever your sell date was that you put on the policy, the Chicago price dropped to drop $15 or drop to whatever it is a pound, this will make up the difference to whatever you locked in, to whatever price is current when you sell. It'll make up that difference. And what's unique about this is it doesn't actually matter what you sell your livestock for. So say that you have a contract in place that you already locked in your sale price, but you can still use this and buy at a current price. And if that price drops, even if you're still locked into your contract, and sell your livestock for the high price, but the Chicago price dropped, you can still get a claim covered through that. We've been seeing an increase of people utilizing this. It's kind of, to me, it's a little bit newer of a product, but just want to include these two on there. And that's kind of the overview I wanted to give everybody. Kind of a lot of information just thrown your way. I might have used some lingo that us insurance nerds know that might not be familiar. So wanted to open up to some questions, see if to clarify anything, go from there.
Great. Thank you, Braden. I feel like that was super informative. I have over a page of notes that I took on it. So let's see. Maddie, did we have any questions pop up?
Yeah. The first one is, can you have different deductibles on property and liability?
Yes. So those are usually always going to be different deductibles, and you can have different deductibles for multiple different things. So even on property by itself, your owner-occupied houses, you can put a different deductible on than all your farm buildings or outbuildings. So, and then equipment as well. You can have a different deductible for your actual buildings, different deductible for your equipment, and a different deductible for liability. So those are all negotiable. So whatever you're comfortable with, you can always go back to your broker to go back to the carrier to see what all options are available. That's a good question.
Great. So on the workers' comp at the beginning, you covered a corporation and an LLC. What about if the operation is in a trust? Is there any way to maneuver the workers' comp for a family in a trust?
Yes. So trusts, you have to look at the beneficiaries and the trustees, and then the relationship. But yes, you can also have the exclusions apply to that. Sole proprietorships is the one where it's only going to be the spouses, the husband and the wife, going to be the ones eligible for exclusions on that. So if you have the sole proprietorship and your kids are working for you, they don't technically have any ownership in the business, so they wouldn't be able to be excluded. But
Okay.
trusts can be worked with.
Perfect. Okay. I'm not seeing any more pop up in the chat, so I'm just going to keep asking my questions. But again, those of you on here, feel free to type it into the chat. What are the most common claims or losses that you see among your ranching clients?
It's going to be auto claims. They're definitely the most common, but a lot of liability claims, especially if, and where you see the big ones is going to be cattle getting out on the roads. And that can be caused by a lot of different ways, but improper fencing, fences going down overnight. We've had some big ones where just overnight a tree falls over onto the fence and the cattle get out that night. Nothing they can really do about that. But we see a lot of claims in that situation. Surprisingly, fire claims, which everybody's excluding, not a whole lot of those. You'll have fields burn up, you'll have grass burn up, but one thing about ranching is ranchers have been fighting these fires themselves for generations, and they have equipment and stuff on hand where they can cut their own fire lines if need be. And that kind of brings up another point that I'll make is when you're talking to your broker and going through your operations, your ability to fight fires and keep your property safe is something that should be discussed. So if you do have some dozers or tractors on premise where you can cut a fire line, you have irrigation on premise where you can flood a field, make sure your broker knows about that kind of stuff. So when he's going to these carriers and getting quotes, that's relayed to them. So they know that this isn't a sitting duck out here, but when a fire comes through, there's nothing that they can do. Anything can help. So make sure that that information's passed on.
As you talk about that, do you feel like carriers are still making their decisions about fire insurance based on zip codes, or has that softened a little bit? And if you have a broker who can really tell your story, are you seeing some flexibility in that?
So it's always funny when the insurance carriers and the insurance marketing people come to my office. They will always tell me that they'll look at individual risks. They're not going to blanket a zip code, and they'll look at what safeguards are in place. But whenever I send something into the actual underwriter, that doesn't seem to be the case. So there's a disconnect there. They aren't supposed to be able to say this zip code is wildfire. We're not going to write anything in this zip code. But that doesn't necessarily mean that's not what they're doing. So we are seeing a lot of that, but there are some carriers out there that will look at individual risks, especially where I've been having the better success is up in the high desert in the Susanville, Milford area, where once you get east of the Sierras there, and there's a lot of just irrigated pasture, there's not a lot of trees, but it's rural. So we've been able to use mapping, getting carriers out to come visit the property and be like, you really think a fire is going to come through here? It's not. But a lot of these underwriters, they don't know what's up in these areas. They've never put eyes on them. So asking your broker to share these maps, share these overhead views, invite the carrier out if you're able to get eyes on the actual property can help put them at ease. It's not a guarantee that means they're going to write it, but it can help.
Great, thank you.
Next,
Go ahead.
got a question next for you, Braden. What is the largest cattle road claim that you're aware of? Like, what would be an approximate average claim?
So for a cattle on the road claim, I mean, the largest one that I've seen has been up over $4 or $5 million. Average, depending on, hard to put an average on there because so many things can happen. But I would say anywhere between 100,000 to 500,000 would be kind of an average for those type of claims. But it all depends on if the cattle gets out and it's a bus of school kids and that crashes, obviously that's going to be a lot bigger. If it's just damaging a single car and not a lot of injuries take place, you're going to be paying for that car. And if there are any injuries, it's maybe a small amount. So they vary a lot, but largest 5 million plus, average, you're at least going to see probably around 50,000.
Cool. You got another one over there?
Yeah. The next one is, what are the most common ways that ranchers lose their policies?
The most common way they lose their policies, I'd say, change in appetite for the carrier. So I would say it's nothing the rancher has done or did in the claims. It's all about just the carriers and their underwriting guidelines change, their appetites change, their wildfire maps change. So that would be the number one reason. The second reason would be either claims or age of property. So if you have a lot of older buildings, not a lot of upkeep on buildings, they go out and inspect them, they see they're not well taken care of, old roofs on them, a lot of overgrown brush around property, up against the building specifically. Those would be kind of the main things. But vast majority of it's going to be just insurance carriers' guidelines have changed and they're no longer a market for them.
Thank you. All right. Next one we have is in regards to notifying the broker of equipment for firefighting, like cats, etc. Does that create an expectation and responsibility to defend the property?
No, it would not at all. It doesn't, coverage-wise and creating that expectation wouldn't come into play at all. What it's mainly doing is making sure the carrier knows that you have the ability, not the expectation, but the ability to do that. So if there was a fire, you have all this equipment, we put together a great narrative explaining what you can do, but you weren't around at the time, or you decided, yeah, it's not worth it, let's just get down the hill. Coverage-wise, that's not going to change anything.
Thank you. All right, the next one says, we've seen that our insurance carrier is sending out a risk management person more frequently. It used to be once in a blue moon, but now it seems like every couple of years. How can you recommend producers prepare for these visits?
So that is exactly what's been happening, and I've been experiencing that too. I'm out at insured properties much more often than I have been in the past, because it's kind of for two reasons. One, we're sending stuff out to more carriers, and when we send stuff out to carriers, they want to get their own loss control, so we have new people. But then just, yeah, if you've been with the same carrier for 10 years, you might have seen in the last 8 years, seen your loss control person 2 times. Once when they wrote the policy, maybe once 4 years later. Now it is getting to be almost a yearly checkup. They want to see how things are going. The best thing to do to prepare is keeping property looking nice, keeping brush down, keeping equipment maintained and clean. Because that would be going back to kind of the most common claims that we see for ranchers is dirty equipment that catches on fire. They don't spray their equipment down, their tractors down after use. Get lots of grass build up or whatever in there, and then that will catch fire. So keeping equipment maintained, and normally you'll get. I don't have very many carriers that do like surprise inspections. There will be some leeway or some lead time to when an inspection is going to be done. And if you're like, hey, tell your broker that if carrier wants to come out and you're like, hey, I need to clean some stuff up, I want to get this done before they're out here. Make sure your broker knows that. They can get that pushed back another month. Give you some time to get things in order to make it as clean and presentable as possible. But the big ones are for property, nothing overhanging your roof. Make sure your roofs are clear of pine needles, leaves, that kind of stuff. Gutters are clean, and then equipment is properly maintained. And then you don't have down fences or fences that are dilapidated on the side of the road. Those are kind of the things that the carrier is going to be looking for.
Good deal. What factors would you say have the biggest impact on premium costs for ranch policies when you're looking at them?
So the amount of autos you have is going to be the biggest factor. Auto insurance is very expensive. So if you have a bunch of trucks on your policy and you don't really use 2 or 3 of them that don't leave the ranch, they don't leave the property, they just sit there, but they're registered still, you're paying insurance, you're at least going to pay $1,500 per one of those trucks. Might be an idea to think about, hey, what can we sell? What are we not utilizing that we can take off this policy? Claims are also going to be a pretty good factor. I never want to recommend not submit claims because you pay a lot of money for this insurance and you need to use it when you want to. And one-off claims are never going to hurt you. You can have one large fire loss or one large accident Doesn't really matter how much it is. It's not going to affect you all that much. What the carriers don't like to see, and what will eventually either get you non-renewed or big increases, is a pattern of frequent claims, even if they're small. So if you're submitting every little thing to your carrier, and they're all similar, carrier's going to start to ask, like, hey, what are we doing to fix this? So something that I've seen along those lines is, not as much recently, but a little bit farther back, was a lot of the copper theft claims in wells and pumps. And we would have farmers and ranchers submit 8-9 claims a year on copper theft. And before long, the carrier is going to be saying, you got to do something to fix this, because you're doing nothing, and it just keeps happening. So claims are going to affect your premium. Catastrophic one-off claims aren't going to hurt you as bad as smaller, frequently submitted claims. So I'd say just what you're insuring is going to affect your premiums. If you're going back to the adjusting values, if you're overvaluing your equipment and haven't looked at those limits in a long time, you can save some money by lowering those to what the equipment or the property's actually worth and not overpaying. That will affect your premiums, just getting things accurate. And then, yeah, some claims.
Good deal.
All right, this is a follow-up to the question about insurance carriers visiting more frequently.
Mhm.
They usually call me directly, and then my broker seems surprised. Is that normal?
It can be normal, and a lot of it goes back to how the broker set up communication. So I don't necessarily like carriers reaching out directly to my clients without reaching out to me first. So if that's happening, either one, you can tell the insurance carrier, hey, schedule this through my broker, reach out to him, and have all conversation flow through one person being your broker. Or have your brokers tell the carrier, hey, if we want to reach out to my insured, please reach out to me, we'll get whatever we need scheduled. But no, it's not uncommon for the carrier to reach out to you directly. And like I said, a lot of it just has to do with either it wasn't made aware to the carrier that they wanted the communication to go through the broker, or the broker never notified them that that's how they wanted to do it, or it's a new loss control person on the team that isn't aware of that. But it's not uncommon, but it's not how I personally like to do things, because I like to make sure I'm in the loop of everything that's going on. So that's just a conversation you can have with your broker about how you want things to go.
Good deal. Well, Braden, we've reached about noon. This has been so informative. I can't thank you enough. I think our landowners are going to get a lot from it. For those of you here, we will send out a recording of this next week, and Braden's contact info, because honestly, I think the biggest takeaway from this is that you really need to have a broker that you trust, that understands your operation, and that has the time, honestly, to give you and to pay attention to these changes that are happening, And so, obviously, we think Braden is a great person, and to educate you on that and to take the time. So we will be sure to share your info if any of the landowners have questions and want to follow up with you more on what you shared today. But with that, thank you very much. And I hope everyone has a great afternoon.
All right, thank you.
Thanks. Bye.